The Bank of Canada raised its key interest rate target for the first time since slashing its benchmark rate to its rock bottom level at the start of the COVID-19 pandemic. The key rate is increased by 0.25 percentage point to 0.5% today to help fight inflation, which is at its highest since 1991. The higher rate is expected to prompt the country's big bank to raise their prime lending rates, a move that will increase the cost of loans such as variable rate mortgages that are linked to the benchmark. The bank said the labor market setback should be temporary and strong household spending should strengthen further as public health restrictions ease, as several provinces have started to do this month.
Well, certainly that this is probably the start of future rate increases, and that's already been priced into the market. We're expecting probably somewhere between 5 and 6 for the rest of the year, which is significant, although that would still just get us up to where our interest rate was prior to the pandemic. But when they're talking about the way forward, the fact that it's a focus on interest rates and that's going to be the primary tool for addressing inflation was something new that came out of this. There was talk about the Bank of Canada's balance sheets, and maybe we'll hear more about that. There was a signaling that there were going to be rate increases, but there have been some very important developments since then. That was at the end of January. First of all, that we had our January CPI numbers come in, and they were much higher than expected. So CPI 5.1% in January, the highest in 3 decades. And certainly, I imagine that was probably playing into his decision. Secondly is, of course, the growth numbers we saw yesterday when it comes to GDP as well. The economy was relatively hot in the fourth quarter last year. We saw 6.7% annualized growth during that quarter, which is higher than the Bank of Canada's expectations, higher than most expectations as well. And that includes relatively flat growth in December because of the emergence of the Omicron variant as well. And so, between the time of the last interest rate decision and this one, they've had some indications that the economy is actually picking up much more quickly than was initially anticipated, that economic slack is being absorbed much more quickly than initially anticipated. And so that's certainly probably playing into some of the decisions that we saw today, the geopolitical situation as well. So certainly, we're seeing potential disruptions of supply chains due to the invasion of Ukraine. A lot of that, or most of that, is being felt in Europe and Asia, not as much in North America. But of course, we're also seeing an increase in energy prices, and that has a huge impact on inflation globally, but in Canada in particular as well. And so that's probably plays into the interest rate decision as well, is that apart from the factors that we were already thinking about, there are these new factors that might also be helping to fuel inflation going forward too. Of course, the Bank of Canada has certainly signaled that its priority is focusing on addressing that and bringing inflation back down to its target rate. And so we can expect potentially further rate increases over time. But one thing that's very important to keep in mind is that usually when we see interest rate increases, that doesn't necessarily start to affect our inflation numbers until somewhere between 6 and 18 months afterwards. And so at least in the short term, we can certainly expect to see more inflation for the next few months. The two largest kind of drivers of inflation that we're seeing right now, first of all, has to do with food prices. They're likely to rise further if the conflict continues. Wheat and corn are two of the major commodities exported by Ukraine. And so that's certainly going to play a part in inflation going forward. And then, of course, energy prices have surged globally, with European benchmarks particularly affected, but certainly WTI also being affected as well. And that playing a role in inflation, definitely over the short term too. On the flip side as well, looking further beyond the short term to the medium term too, something that we need to keep in mind is, apart from inflation, how might this also impact GDP and growth going forward too. And of course, Canada is a large energy producer, and so it will have a potential positive effect in the short term. When these prices start to hit consumers in their pocketbooks, when they start to hit businesses in terms of input costs, what type of impact will that have on growth and our GDP forecast going forward as well? And so that's why it's quite a bit, it's a fine balance basically for monetary policymakers and for the Bank of Canada to be able to address inflation while at the same time, trying to ensure the level of growth is necessary for economic recovery coming out of the pandemic.
Thank you for watching Awaz News, and stay tuned for more updates.